Hey folks, it's Iggy here from the Investing Iguana. Let's have a good chat over coffee, just like two friends digging into this business over copios. So here's a sticky one for Singapore investors. DigitalCore REIT's latest Q3 2025 update just landed in. The discount is massive. Right now, the REIT's trading nearly 40% below its net asset value. At the same time, data center rents, driven by AI's huge demand, are hitting record highs. So what exactly is going on here? Is this bargain the buy of the year, or is there something ugly lurking beneath the surface? Today, I'm walking you slide by slide through the full report, unpacking all the numbers and real estate moves, figuring out what it means for our CPF/SRS plans. If you're new, I break down Singapore REITs, so you don't have to stress the details. By the end, you'll know whether DigitalCore deserves space in your portfolio or just a spot on your watch list. Let's get into it. First up, the update kicks off with a strong set of highlights. 98% occupancy, leases averaging 4.7 years left, 11 data centers spread across the world's most competitive regions, and a cool USD 1.7 billion in assets. In the first 9 months of 2025, distributable income came in at 35.2 million, up almost 2%. Not a huge jump, but in a year battered by inflation and interest hikes, a steady climb is worth something. You'll like this if you worry about debt. Leverage sits at 38.5% with over USD 400 million room before hitting the 50% cap. 86% of the debt's locked at fixed rates, so rising interest rates shouldn't hurt too badly. And there are zero maturities till December 2027. Osaka's expansion shows management isn't just sitting on their hands, they're moving into Japan's AI growth hub. And you know what else? They bought back 1.8 million units at USD 0.565, a sign the folks running the ship think shares are undervalued. So what's the story here? Stable, high occupancy, and smart debt management give DigitalCore flexibility. For investors after predictability, that's reassuring. Next slide focuses on Northern Virginia, the REIT's pride and joy. Imagine a sprawling 32-acre campus packed with top-tier infrastructure. Think security, water, cooling. This isn't your average storage shed. You know how they say location is everything? Here, vacancy rates are basically zero. This gives landlords the upper hand. For DigitalCore, their Virginia properties churn out 33% of rent, and every square foot is occupied. Here's the fun bit. AI makes these properties real gold mines. High-power racks need crazy cooling and reliable water. Properties that have both can command premium rates. There's Hastings Drive, fully fitted, owned 90%, 100% occupied. Devon Saffron Drive, shell and core, full occupancy. Plus Linton Hall Road, which is being spruced up for tomorrow's leasing opportunity. For local investors, it's good news. Ultra-low vacancy with credible tenants means income is steady. But remember, this also binds results to U.S. macro factors. Let's talk about market conditions. DigitalCore operates in places with record low vacancies and surging rents. How low? Northern Virginia, Frankfurt, Singapore, vacancy rates run between 0.2% and 0.4%. In 1 year, Northern Virginia's wholesale rents jumped from USD 130 to USD 180 per kilowatt per month. That's not just a blip. Why? AI workloads are power hungry. Building new data centers is tough with regulations, and that turns land and existing sites into scarce resources. The value is not just theoretical. Recent deals in these regions back up the numbers. So why does this matter? DigitalCore has direct exposure to these high-demand locations, something you don't see often in Singapore REITs. But execution is key. The market rewards strategies, not just setups. Here's what excites value investors. DigitalCore is trading at a 39% discount to NAV and offers a fat 7.5% yield. When you stack that next to Keppel DC, premium to NAV, 7.3% yield, or Ascenders or Mapletree Industrial, premium and smaller yields, it jumps off the page. Why the bargain bin price? It's a smaller REIT with pure data center exposure, less liquidity, and higher leverage than big names. DPU growth isn't dazzling, just 1.9% this year. And some players still worry about sponsor relationships and possible asset pricing conflicts. Bottom line, for folks who love high yield and low price to book, this setup screams value. But the execution side needs to clear more hurdles for a re-rating. Let's pull back. DigitalCore runs 11 centers across the US, Northern Virginia, Silicon Valley, LA, Toronto, Europe, Frankfurt, and Asia, Osaka. Every single asset is freehold, no pesky lease decay. US markets make up half the rent, while Frankfurt and Osaka give geographical diversity. Property mix: 84% fully fitted facilities, 10% shell core, and 6% colocation. Triple net leases, where the tenant shoulders most expenses, cover 63% of contracts. No scrambling for quick renewals either. Most rent is locked in till 2031. So, the story here? Freehold assets, triple net contracts, and solid lease ladders make for a boring but beautiful recipe: stability and predictability. DigitalCore has more than 120 customers, but most of the rent comes from heavy hitters. 79% is paid by investment-grade tenants. The top 10 clients, big tech and social media giants, bring in nearly 86% of all rent. Tenant split tells a story. 61% cloud hyperscalers, 33% colocation/IT players, and 6% social media other. Triple net contracts with these big tech firms drop the risk of default way down. What I find interesting? Yes, it's concentrated, but these are clients with deep pockets and long-term needs. For Singapore investors, that's less risk and more steady ship, at least for now. Right now, 10 assets are up and running, one more is under redevelopment, Linton Hall. Total value stands at USD 2.58 billion gross, or USD 1.71 billion at the REIT share. Northern Virginia and Frankfurt bring in most of the rent, but Osaka and Silicon Valley are the expansion wildcards. Once Linton Hall gets leased out, that could mean a big jump in distributable income. The summary? High occupancy, long average lease expiry, and expansion options set up growth. The freehold status means any value-add work stays with the REIT. In the first 9 months, cash collection soared. USD 132.4 million revenue, up nearly 84%. Net property income up almost 50% to USD 67.7 million. Actual distributable income, though, inched up only 1.9%. Why? Rising finance costs and other trust expenses ate into net profit, and associate income was down a third thanks to those higher rates. Tax also climbed. Net profit dropped dramatically by 21.7%, but after stripping out non-cash items, distributable income was still up a smidge. So how come it's stable? Bigger costs ate up top-line growth, but operational income held steady. In this climate, sometimes boring financials are worth celebrating. Assets ballooned to USD 2.19 billion after expansion. Loans rose to USD 671 million. NAV per unit dipped to USD 0.78. Market price at USD 0.475, a fat discount. Leverage sits well below the danger zone, and most of the debt is unsecured at an average 3.5% cost. Smart moves for balance sheet health. So, what does that mean for us? Moderate leverage and defensive structuring point to safety. For CPF SRS holders, it stacks up well against local options. Debt maturities are no worry until 2027, with big tranches only due in 2029 and later. 86% of debt is locked at fixed rates. Interest coverage is strong, which means not sweating rate hikes in the short term. Debt headroom means DigitalCore can pounce if deals arise, and if interest rates dip further, margins should improve. Snapshot. Coverage ratios are strong, risk of refinancing stress pushed far out. All DigitalCore's regions, from Northern Virginia to Tokyo and Frankfurt, are seeing rock-bottom vacancy and screaming demand from AI and cloud players. Frankfurt and Osaka expansion fit global trends. Meanwhile, California and Toronto regulatory constraints may bolster values of already owned properties. Meaning, DigitalCore isn't just going with the tide. They're riding growing, secular demand. But keep an eye. Regulatory hurdles can flip from moat to challenger fast. All right, here's my honest take. DigitalCore REIT looks like a quality outfit traded at bargain bin prices. Fundamentals, tenant strength, market tailwinds, defensive balance sheet all point to a solid position. But the slow growth in distributable income and higher than peer leverage are yellow flags. If you ask me, this is a buy for investors who don't mind unloved names and want diversity in CPF SRS portfolios. You get income, you get capital appreciation potential, but you also sign up for short-term volatility. Watch for risks like customer concentration, execution missteps, and sponsor relationships, but don't ignore the upside. If there's one thing I'd leave you with, sometimes the market ignores gems that are too complicated or too small. As Singapore investors with an eye for value, these moments don't come often. By the way, if you want the reference tables, checklists, and the written breakdown, it's all in the Substack post. Just hit the link below. So if you're planning your next move, remember, look past the headlines, scan the market details, and think about your risk appetite. DigitalCore REIT might just surprise us. Let me know below. What are you buying or selling this month? Drop your thoughts, and if you want to be part of our premium membership, join our early access community for smart investor guides and member-only videos. We dig deeper so you can invest smarter. You might enjoy our next video, where we unpack Singapore's REIT market swings and how CPF investors can ride out the volatility. Catch you there.